Welcome to Global Wealth Migration. This channel operates as an institutional intelligence briefing service for high net worth individuals, family offices, and global asset managers navigating the accelerating convergence of sovereign tax risk and jurisdictional exposure. What you will encounter here is not lifestyle content. It is structured wealth architecture analysis delivered at the standard of a private client advisory desk. When we interrogate the aggregate outflow data compiled by the IMF Balance of Payments Statistics and the OECD Global Revenue Statistics dataset through Q4 2025, we observe a structural acceleration in declared fiscal residency transitions among individuals with net investable assets exceeding $5 million. The directional velocity of this movement has increased 34% year on year since 2022. And the composition of origin jurisdictions is dominated by the United Kingdom at 29% of total declarations, followed by South Africa at 18%, Australia at 14%, and Canada at 11%. The data confirms that this is not a marginal capital flight response, but a sustained portfolio-level reallocation of human and financial capital driven by legislative risk premium repricing. The data we just reviewed is the surface layer of a much deeper structural dynamic. The architects of modern sovereign tax systems have progressively closed the gap between domicile and liability, and the result is that the traditional assumption of geographic permanence as a neutral wealth management baseline has been invalidated. Capital mobility is no longer a fringe concept reserved for offshore structuring specialists. It is the foundational risk management discipline for any portfolio above the family office threshold. The vertical index displayed here maps the legislative volatility score assigned by the Fiscal Policy Institute to 12 primary wealth holding jurisdictions ranked against the OECD BEPS 2.0 Compliance Burden Index. The United Kingdom registers a composite legislative volatility score of 8.7 out of 10, driven by the Finance Act 2024 non-dom abolition, the proposed extension of exits, charge provisions to offshore trusts, and the active parliamentary consultation on unrealized capital gains, inclusion in the residence-based tax base. South Africa registers 8.2, driven by Section 9H deemed disposal provisions and the progressive narrowing of the foreign employment income exemption under Section 10(1)(02). These are not hypothetical risk scenarios. They are enacted or actively staged statutory instruments with defined implementation timelines. This vertical exposure matrix disaggregates the total effective tax burden across 5 asset classes for a representative high net worth individual holding a $15 million portfolio across domestic equities, property held to let, offshore discretionary trust structures, and a SIP or pension wrapper under current United Kingdom statutory rates. The cumulative lifetime effective rate on the full portfolio under the Post-Finance Act 2024 framework reaches 54.3%, when inheritance tax at 40% applies to assets above the nil rate band after the removal of agricultural and business property relief protections proposed in the 2024 autumn budget. The pension inclusion in the inheritance tax base from April 2027 adds a further estimated 8.2% to the cumulative effective burden on the total estate in a standard longevity scenario modeled to age 85. The structural inertia that prevents high net worth individuals from acting on legislative exposure data is well documented in behavioral finance literature. The Morgan Stanley Wealth Management Behavioral Research Unit published findings in 2024 confirming that the average advisory lag between a client's first material engagement with domicile restructuring data and the execution of a formal restructuring mandate is 27 months. In 27 months, the 2024 United Kingdom Finance Act becomes fully operational, the pension inheritance tax provisions are live, the non-dom regime is eliminated, and the exit charge consultation may have concluded with enacted legislation. The cost of advisory inertia is not abstract. It is a quantifiable compounding liability that accumulates in direct proportion to the gap between awareness and execution. This timeline chart plots the statutory trigger dates for For the 5 highest impact legislative instruments currently active across the United Kingdom and South African tax frameworks against the advisory lead time required to execute a compliant fiscal residency restructuring before each trigger fires. The critical intersection point for UK domiciled individuals is March 2027, when the pension inheritance tax inclusion takes effect simultaneously with the full phase-in of the new domicile-based deemed disposal regime. The minimum compliant advisory runway to execute a clean exit from UK deemed domicile exposure with full statutory compliance across the statutory residence test, split year treatment, and the offshore trust cleansing provisions is 18 to 24 months. Individuals who have not initiated a formal domicile review by Q1 2025 are operating within the irreversibility window for the April 2027 trigger. This structural risk matrix illustrates the interaction between 3 simultaneous statutory reform vectors that converge on a single cohort of long-term UK resident non-domiciliaries between 2025 and 2030. The Finance Act 2024 abolished the remittance basis from April 2025 and replaced it with a 4-year foreign income and gains exemption available only to new arrivals. Long-term residents who have held UK deemed domicile for 15 or more years of the preceding 20 are immediately subject to worldwide income and gains taxation with no transitional remittance basis relief. The interaction with the offshore trust anti-avoidance provisions in Chapter 2 of Part 13 of the Income Tax Act 2007 means that any income or gains arising in an offshore trust where the settlor holds or has held UK deemed domicile are attributed to the settlor and taxed in the year of arising. The combined impact across a representative trust-held portfolio of offshore equities and real property produces an annual attributed tax liability that can exceed the portfolio yield. What the statutory timeline data demonstrates is that the advisory execution window for compliant restructuring is not elastic. The statutory residence test under Schedule 45 of Finance Act 2013 operates on a day count basis, and HMRC has made clear in its guidance that split year treatment is an exception, not a default. The combination of the day count rules, the automatic UK residence tests, and the sufficient ties framework means that an individual who defers the physical relocation component of their exit plan beyond a certain point may retain deemed UK residence for an additional full tax year, regardless of the formal advisory structure they have put in place. This is the critical distinction between a paper restructure and a compliant executed exit. The former creates a compliance liability. The latter creates structural protection. This framework map illustrates the 4-stage compliance architecture required to execute a clean statutory residence exit from the United Kingdom under the Post-Finance Act 2024 framework. Stage 1 is the domicile of origin and deemed domicile audit, which establishes the precise statutory position of the individual, including the 15 of 20-year clock, the trust attribution exposure, and the offshore income and gains portfolio liability. Stage 2 is the destination jurisdiction selection and treaty mapping, which identifies the optimal combination of low effective rate income jurisdiction, treaty protection, and physical substance requirements. Stage 3 is the physical relocation and day count management protocol, which must achieve the UK non-residence tests under the automatic overseas tests in Schedule 45. Stage 4 is the post-exit compliance structure, which includes the annual self-assessment position, the remittance basis residual protections for pre-exit gains, and the offshore trust restructure or unwinding timeline. This regulatory threshold index displays the interaction between the Common Reporting Standard automatic exchange of information obligations, the FATUC reporting architecture, and the domestic anti-avoidance provisions across 6 target relocation jurisdictions, including Portugal, Italy, Greece, the UAE, Malta, and South Africa. The critical compliance variable for any outbound restructuring mandate is the interplay between the CRS reportable account threshold, the treaty non-discrimination provisions, and the domestic controlled foreign company rules of the destination jurisdiction. The UAE presents a zero personal income tax baseline with no CRS reciprocal reporting obligation to the UK or South Africa, but requires physical presence substance documentation of 183 days per annum to satisfy the automatic overseas test. Malta and Portugal both operate within the EU CRS framework, which means that income and gains information is automatically exchanged with both HMRC and SARS, creating a dual compliance reporting trail that advisory structures must account for at the design stage. This comparative cost index portrait maps the all-in advisory and structural cost of executing a compliant fiscal residency exit across 5 destination jurisdictions against the projected 10-year net tax saving for a $15 million portfolio holder exiting the United Kingdom. The advisory cost envelope for a full domicile restructuring mandate, including tax counsel, trust restructuring, real estate legal advisory, and immigration compliance, ranges from $180,000 to $420,000 USD, depending on portfolio complexity, against a projected 10-year effective tax saving of between $3.4 million and $6.8 million USD, depending on portfolio composition and asset class allocations. The advisory cost ratio sits between 2.6% and 12.4% of the projected benefits. The cost index confirms that the structural barrier to execution is not the advisory fee quantum. It is the combination of advisory inertia and the absence of a clear compliance-first roadmap. The purchasing power arbitrage dimension of a fiscal residency restructuring is systematically underweighted in private client advisory conversations, because it sits outside the narrow statutory compliance framing of traditional tax advisory engagements. When a United Kingdom resident with a $15 million portfolio relocates fiscal residency to South Africa and simultaneously repositions a portion of liquid capital into rand-denominated income-generating assets, the transaction involves not only the statutory tax saving, but a structural reconfiguration of the cost base against which the portfolio is measured. South Africa's Atlantic seaboard residential property market, priced in British pound sterling, represents a discount of approximately 67% relative to equivalent quality residential real estate in Greater London. The same disposable income denominated in rands at current exchange rates purchases healthcare, private schooling, domestic services, and food at a fraction of the sterling equivalent cost. When this purchasing power differential is compounded across a 10-year planning horizon and integrated into the portfolio's net return calculation, the effective yield enhancement from the geographic arbitrage component alone produces a return contribution that rivals the direct tax saving. This case study dataset presents the anonymized portfolio architecture and statutory exposure profile of a 52-year-old United Kingdom deemed domiciliary holding a net investable estate of 18.4 million GBP, comprising a property portfolio of 6.2 million GBP, a discretionary offshore trust settled in Guernsey, holding listed equities and private equity co-investments of 9.1 million GBP, a SIP pension wrapper of 2.4 million GBP, and liquid cash and near cash of 700,000 GBP. Under the current UK statutory framework, the combined income tax, capital gains tax, and inheritance tax liability on the full estate in a standard mortality scenario produces a cumulative effective rate of 57.1%. The offshore trust attribution provisions produce an annual income tax liability on trust income of approximately 312,000 GBP per annum at the current attributed gains rate. The pension inclusion in the inheritance tax base from April 2027 adds an estimated 960,000 GBP to the inheritance tax exposure on the SIPA wrapper alone. This advisory mapping portrait details the 4-pillar restructuring architecture recommended for the case study A profile, including the statutory sequencing, the treaty protection mechanisms, and the projected outcome metrics. Pillar 1 is an immediate statutory residence exit structured through the South African fiscal domicile framework with a physical relocation timeline of Q3 2025 to achieve clean UK non-residence under the automatic overseas test for tax year 2025 to 26. Pillar 2 is an offshore trust restructuring to achieve settle exclusion status under the Finance Act 2024. Grandfathering provisions eliminating the annual attribution liability from 2025 to 26 onwards. Pillar 3 is a SIP crystallization and annuity purchase strategy executed before April 2027 to remove the pension wrapper from the inheritance tax base before the statutory inclusion date. Pillar 4 is a RAND-denominated liquid asset reallocation targeting 15% of the post-exit portfolio in South African income-generating instruments to capture the purchasing power arbitrage. The projected 10-year net saving across all 4 pillars relative to the do-nothing baseline is 4.7 million GBP. Case Study B presents the portfolio and exposure profile of a 44-year-old South African domiciled individual holding a 22 million USD equivalent portfolio comprising South African listed equities, 3 million USD unlisted private equity co-investments of 6.1 million USD, a residential property portfolio across Cape Town and Johannesburg of 3.8 million USD and offshore USD and UR cash, bond holdings of 3.8 million USD held through a Mauritian administrative holding structure. The Section 9H deemed disposal provisions under the Income Tax Act No. 58 of 1962 apply immediately upon the individual ceasing to be a South African tax resident, creating a deemed disposal and immediate capital gains tax liability on the total portfolio, including the offshore cash and bond holdings, at the current effective rate of 18% on individuals. The interaction between the Mauritius holding structure and the South Africa-Mauritius double tax agreement creates both a treaty protection opportunity and a substance risk that requires specific advisory management before the exit is executed. This restructuring mathematics portrait details the advisory cost breakdown and net outcome projections for the case study B exit restructuring. The Section 9H deemed disposal liability on the taxable portfolio at exit is calculated at 2.86 million USD, representing 13.0% of the total portfolio value before accounting for the treaty-protected offshore holdings. The Mauritius Structured Treaty Analysis confirms that the offshore cash and bond holdings qualify for reduced withholding and limited source state taxation under Articles 10, 11, and 12 of the South Africa-Mauritius DTA, reducing the effective attributed liability on those holdings by approximately 620,000 USD. The net Section 9H liability after treaty optimization is 2.24 million USD. Against a projected annual effective tax saving post-exit of 840,000 USD per annum. The payback period on the exit liability is 2.7 years, making the restructuring financially compelling at any advisory lead time of more than 3 years before a natural liquidity event in the private equity co-investment portfolio. The total advisory cost for the full restructuring mandate is estimated at 310,000 USD. The sequential checklist matrix and critical statutory deadline schedule represents the operational execution roadmap for a compliant fiscal residency exit, covering both the United Kingdom deemed domicile framework and the South African tax resident exit framework simultaneously. The matrix is structured across 8 execution phases, beginning with Phase 1, the domicile audit and exposure, quantification, and concluding with Phase 8, the post-exit annual compliance maintenance protocol. Critical statutory deadlines highlighted in the matrix include the April 5, 2025 UK tax year end, the final date for pre-exit remittance basis elections, the April 2027 pension inheritance tax inclusion date as the hard deadline for SIP crystallization strategy, and the Section 9H deemed disposal filing obligation which arises in the tax year of departure and must be reported in the individual's final South African income tax return within the standard 12-month filing window. The matrix confirms that the minimum compliant advisory runway from mandate initiation to clean statutory exit is 18 months for the standard complexity profile and 24 to 30 months for profile involving discretionary offshore trusts, private equity co-investments, and multi-jurisdictional real estate holdings. The analytical framework we have established in this briefing represents the structural foundation for the intelligence series that follows. In episode 2, we will deliver a comprehensive operational deep dive into 3 of Europe's most structurally compelling fiscal residency alternatives, beginning with Italy's €100,000 annual flat tax regime, which was enacted under Article 24 bis of the Italian Income Tax Code, and which provides a fixed annual substitutive tax on all foreign source income and gains, regardless of quantum, making it the most capital scale friendly fiscal incentive in the G7. We will also provide an institutional analysis of Greece's non-domiciliary residency framework under Article 5A of the Greek Income Tax Code, and a structural assessment of the real operational realities of European fiscal havens, including the substance requirements, the CRS reporting obligations, and the treaty interaction with the jurisdictions of origin. In episode 3, we will deliver an institutional masterclass on 3 of the most time-critical strategic decision points currently facing high net worth individuals, including the mechanics statutory deadline, cliff of the United Kingdom's temporary repatriation facility at its 12% statutory rate, which closes at the end of the 2027 tax year, the multi-year duration-based inheritance tax look-back tail that applies to former UK deemed domiciliaries under the Post-Finance Act 2024 framework, and the tactical purchasing power arbitrage case for a physical residency exit to South Africa's Atlantic seaboard, presented as a rigorous quantitative model rather than a lifestyle proposition. These are not speculative future topics. They are active advisory imperatives with statutory deadlines that are already running. The foundational premise of global wealth migration is that the geographical configuration of a high net worth individual's fiscal residency domicile and asset custody architecture is not a compliance afterthought. It is the primary determinant of long-term portfolio preservation at scale. Every percentage point of effective tax burden that compounds across a 20-year planning horizon represents a geometric reduction in the terminal value of a portfolio that was built through decades of capital allocation discipline. The jurisdictional frameworks that sovereign governments have constructed around that capital are not static. They are legislative instruments subject to political cycles, fiscal pressures, international coordination mechanisms, including the OECD Pillar 2, global minimum tax, the Common Reporting Standard, and the evolving BEPS framework that are systematically narrowing the operational space available for passive wealth preservation within any single high-tax domicile. The individuals and families who will preserve multi-generational wealth in the current legislative environment are those who approach domicile residency as an active portfolio allocation decision rather than an inherited administrative status. Legacy asset decoupling is not a transaction, it is a discipline. Geographical engineering of a wealth portfolio is not avoidance, it is the institutional application of the same jurisdictional arbitrage logic that sovereign wealth funds, pension funds, and global asset managers have applied to their own capital structures for decades. The difference is that individual high net worth clients have historically lacked the institutional advisory infrastructure to execute these strategies with the same rigor. This channel exists to close that gap. The intelligence briefings you will receive here are built on the same data sets, the same statutory analysis, and the same advisory frameworks used by the private client divisions of the major international law firms and global wealth managers. The objective is long-term financial autonomy, measured not by the gross quantum of assets, but by the proportion of that capital that remains under the structural control of the family that created it, after all sovereign claims are extinguished. That is the mission of global wealth migration.
Join our community of informed investors to stay ahead. This data is for education and is not financial advice. Always consult a professional before investing. To speak with one of our specialists, click the link in the description. I'll see you in the next report.